Hey gang, welcome to Time in the Market investing channel with a long-term focus. Revisiting Lululemon this morning, did a video on these guys 2 or 3 months ago. Check that out for a more in-depth look. Just wanted to look at the earnings themselves. Stock is up about 9% pre-market, trading at 336, was as high as 350 right after the earnings were released. Down since then, but still up. Obviously, pre-market, we'll look at what that looks like. Stock is down quite a bit in the last 6 months, and I think a lot of that is due to worries around where their growth is going to come from, whether growth is slowing. This is a company that has grown 20 to 30% for the past couple of years, and now is projecting to grow in the low teens. Is that the norm? Is it going to slow from there, or can it get back to growth after this? That's kind of the questions investors are asking themselves, and why the stock is down from a high of 500 down to a low of 300 just a few days ago. Pre-market, it's up to 336. Again, growth up about 10% for Q1, EPS up about 11%. Revenue, maybe a 60 basis point beat, EPS maybe a 15-cent beat versus expectations. So the nice thing about this is that though revenue is slowing, margins are expanding, which is really interesting to see, especially due to where their expansion is coming from. If you look at the revenue growth in the Americas, it's only up about 3%, but international is really driving most of their growth, up about 35%, and really one of the reasons that they're up as high as the 10% you see in Q1, because Americas is struggling, and that's where the majority of their business is coming from. Now, the interesting thing is that usually when you see expansion overseas, margins struggle, but that's not the case here. So as an investor, if I were an investor, I do not own any shares of Lulu, I'd be really happy with margins actually expanding with an expansion coming from international revenue. If you look at the actual sales, 73% of the revenue comes from the Americas. That's down from 78% in the last year. That's because China is growing so fast. That's because the rest of the world is growing so fast. China up about 45%, rest of the world up about 27%. That's where their future growth is coming from. The Americas seems like it's maturing, and they really talked about that specifically, how the Americas market is seeing pressure on the consumer. They're pulling back on expenses. The nice thing to see is that they mentioned that they're actually expanding their market share in a lot of their business areas. They're not losing it against some of their competitors, whether it's Fiore, whether it's Aloe, whether it's whatever, Fabletics. They're expanding market share. It's just like that the consumer is struggling. And that's a common theme across retailers, across companies like Lululemon in the Americas, and their growth is coming overseas. And that's why when you look at their store count, they expect to open 35 to 40 stores in the next year, and only 5 to 10 of those are going to be in the Americas. The rest is going to be overseas, mostly in China, because they want to grow that market. They feel like they can maintain margins in those markets overseas and get really good growth, and that's going to spur their growth for the next couple of years, because I think Americas is going to struggle. And as an investor, you have to be okay with that. You have to be okay with the fact that a year ago, Americas was 78% of their revenue. This year it's 73%. In the long run, they said the goal is for Americas to be 50% of their revenues and the rest of the world be 50% of their revenues. And as long as they can maintain those margins in the rest of the world that they have in the Americas, that's not a problem. But the worry is always going to be that those markets can be a bit more finicky when it comes to that. And if you have some pricing wars in China that put pressure on your margins, that could be a long-term concern for investors. Looking at other things, share count down. They're spending a bunch of money on share buybacks, almost 300 million in Q1. They have another 1.7 billion remaining authorized on their stock repurchase program. So next couple of years, they're going to be buying back a bunch of shares. On the CapEx side, they're investing in distribution centers. That's been the case for the last couple of years, probably going to be the case for the next couple of years. But as that matures, that's going to lead to improved margins as those CapEx expenses come down. Balance sheet looks fantastic, 1.9 billion in cash, no debt, some capital leases, inventories down 15% year over year, basically flat quarter over quarter. As we look at outlook for 2024, Q2, not that impressive, only 9 to 10% growth, but improving EPS for 2024 itself, and growth of 11 to 12% for 2024. That's a nice thing to see. Yes, growth unchanged for 2024 versus what they projected last quarter, but margins are improving, and that's especially important given where their expansion is coming from. So why is the stock down as much as it's down the last couple of months? Well, again, going from 42% growth, 29% growth, 18% growth, down to low teens, projected to be kind of in the high single digits for the next couple of years. Is that going to be the case If it is, then maybe the valuation is fair. As we look at the valuation, as always, remember guys, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence before investing. We're looking at the stock. I'm kind of looking at a 330 price point, kind of projecting where the market's going to open it for a fair valuation. That's a 4% free cash flow yield. Seems relatively fair for a company like this where growth is slowing. This is a company that's traded in the 2 to 3% free cash flow yield range for a while. That's why it's down as much as it's down, because investors are refocusing on, well, where's growth going to come from? What does that mean for margins? What does that mean for growth in general? Americas is obviously slowing. International is booming, but how long is that going to continue? Can they do something about Americas to get it back to growth? Their men's business is doing well. Their women's business is doing okay. They talked about how some of the releases they had this year didn't have the right color palette. It's funny the things you hear on some of these calls. Customers wanted more vibrant colors. They didn't have that. As they look forward to 2024, they're going to give more vibrant colors to their consumers. They have some interesting product launches coming up ahead, and I feel pretty good about Q4 and Q3 growing at a faster clip and really getting it back to 11 to 12% growth for the year. That does include a 53rd week. Keep that in mind. So it's really 10 to 11% growth. So you're going from a company that grew at 19% last year, probably going to grow at 10 to 11% this year without the 53rd week. And the question is, what's going to happen after that? I think the expectations are that it's going to continue to grow at about 10 to 9%. That's what I have baked in here. Free cash flow margins at about 13.75%, expanding by about 25 basis points year over year as those capital expenditures come down a little bit. They're still generating a ton of free cash flow. The question is always going to be, I have a 14.75% free cash flow margin by 2029 fiscal year. Is that too high? A company like Nike kind of has 10 to 11% free cash flow margins. Can a company like Lululemon maintain free cash flow margins that are 500 basis points higher than that, especially as more of their revenue comes from international markets? Do they have to put more items on sale in those markets as competition ramps up there? Obviously, Lululemon is a hot new brand in China right now. You've seen this story before with a lot of other brands. Starbucks, for example, is right now in a price war with some of the other players in China because Starbucks was a hot brand for a while. Now it's like, well, money's more important. Obviously, coffee and leggings aren't comparable, but stuff like that happens all the time in China where a hot new brand comes out, but there's a lot of cheaper knockoffs in China that will compete with you and potentially put your pricing down. Right now, your margins are very healthy, comparable to the Americas overseas. But if 2 years, 3 years, 4 years from now, 40% of your revenue comes from China and you're in a price war there, will margins be pressured? That's the question as an investor I would be asking myself. When I look at what they're going to do with their money, I'm putting half of it towards buybacks. Seems very reasonable. They're going to generate $9 billion in free cash flow. 4.6 billion in buybacks seems maybe aggressive given that they've only bought back about 1.6 billion in the last 3 years. But as they generate more free cash flow, they're going to use more of that to buy back shares. They have $1.7 billion in authorization outstanding right now. So it seems reasonable they're going to use that and then do another authorization, because I don't see them making any acquisitions. Obviously, they're investing in the business, opening more stores, etc. But that's already reflected in the cash flow, and the investments in the distribution centers are as well. Those aren't going to last forever. Their free cash flow, their capex in 2022 was something like 300 million. In 2025, it's going to be closer to 600 million. I think it's going to come down, and that's going to lead to improved margins as it does. I'm always worried about margins. That's my main worry with a company like this. Where are margins going to be 5 years from now? Because if they can maintain mid-teens margins for a long, long time, then this is a really best-in-class business. And right now, they are kind of a best-in-class business, which is why people love it, but I'm worried about it. However, on the other hand, I could also see it being higher than 14.75% because they've hit as high as 16, 17% a couple of years ago. So if you're more bullish on this than I am, you can certainly play around with these numbers, fit, file, make a copy to adjust as you see fit. But for me, this makes sense. As I look at their valuation, 4% makes sense as well. Revenue growth is slowing. Yes, margins are improving, but at the end of the day, a 4% free cash flow yield is relatively reasonable. If you look at a mature company like Nike, they have a 5% free cash flow yield. Does a 4% free cash flow yield for a company that's starting to reach, not quite maturity, but it's getting there. Once you get to 9% growth, that's only going to keep coming down. Now, obviously, the upside from here is going to be, hey, the expectations are that growth is starting to slow. It's going to be 10%, it's going to be 9%, it's going to be 8%. It's going to eventually start to come down to low single digits. If that doesn't happen anytime soon, a 4% free cash flow yield might be too low. If suddenly next year they're up 13% and revenue in the Americas is growing again, maybe the market reevaluates this to 3% again. And that could be realistic. That gets you a 14% return. But as I look at it at a 4% free cash flow yield, I get about an 8.3% return from today's prices at the 330 I have assumed in there. If I'm looking at a 10% target return, which I usually am, gets me to a fair value of 305, which is where the stock was trading just a couple of hours ago. Basically, yesterday you could probably get it at 305. Makes sense to me. If I was a buyer of Lululemon, I'd kind of be targeting that price point. But I'm also not shocked that it's at 330. It's like, this is a very good brand, a marquee brand. They're doing something really well. They're gaining market share against a bevy of competitors in the Americas, even though the Americas market is slowing a little bit. It's pressured a little bit overall. They're growing overseas, probably going to open a bunch of stores there, grow in spades. The question is always going to be, can they get Americas back to growth? If they can, and they can continue growing overseas and maintain margins there, this could be a really good return from here. But my assumptions right now are things kind of continue as they are. America's growth is low to mid single digits, maybe a bit higher than that. Overseas growth is in the high 20s, low 30s for a while, and margins continue to be solid and or expand a little bit. If you agree with that, then a fair value of 305 makes sense. If you disagree with that, if you think it's going to grow faster, margins are going to be better, play around with this, get your own number. Let me know what you think in the comments down below. For me, this stock, I had a fair value at like 305, 310 when I did my last analysis. It hit that number a couple of weeks ago, didn't buy it simply because I don't think I want to be an investor in a company like this right now. I would need a bit more of a buffer in order to invest in it. And it might sound crazy, but I'd probably target something like a 15% target return at a price point of 250. You're probably saying it's never going to hit that. Yeah, probably not. But I just don't want that much exposure to consumer goods in a time where the economy might be slowing down a little bit. And it clearly is, given what Lululemon is saying, that, hey, we're gaining market share, but our growth is basically inflation. So something clearly is happening in this business model, in the Americas at least, that is maybe a longer term trend than they'd like to admit. And yes, they can say we're going to expand overseas a lot, build a lot of stores. But once that matures, what's their next growth path after that? I don't think their sneakers are doing that amazing. I see a lot of them on sale, but the other business lines are doing really well. At the end of the day, this is still a really strong company. If you own shares here at 330 and you are holding, I don't blame you. But I already have exposure to consumer goods in the CROX area. When I bought that company, it was like a 10% free cash flow yield. And that's kind of what I look for. I look for something that, hey, maybe it's not growing as fast as Lululemon. Maybe it's not as great a brand as Lululemon, but I can get the valuation at basically 50% of what Lululemon's giving me. And at that time made sense to me. That stock is up about like 80% since I bought it. Good win for me. If Lululemon were to do something like that too, if suddenly it's trading at a 6% free cash flow yield because it's slowing growth and it's trading in the low 200s, mid 250s, would I be a buyer because I really like the brand? For sure. I'd buy it hand over fist. But at 330, even at 305, I think it's a good company at a fair value. But right now I'm looking more for a good company at a good value or a great value. And I don't think Lululemon is quite there at the $330 price point. But I think they could also have a lot of upside from here if they execute really well, if they can get Americas back to growth, if they can keep margins as they are for 5 to 10 years overseas, which I think is going to be tough. This could be a good long-term compounder. But from a realistic standpoint, given all these values, it's about an 8% return, which is pretty good. It's not bad at all. But usually I look for something at least 10% or more. And in that case, that'd be a fair value of 3 or 5. Let me know what you think. Do you disagree? Do you agree? Also, one thing to mention, their chief product officer recently left. Whether that's a big deal or not, who knows? But it's something to mention. Certainly the market was worried a bit about it. But at the end of the day, I think they can still release cool new yoga pants and people will buy them because people do love this brand. That's the one thing you're buying here. You're buying a really strong brand. and I think that's not going away anytime soon. But there's always a worry that these things ebb and flow. Will Lululemon be as strong a brand 10 years from now as it is today? It's hard to tell. It's always hard to tell. And that's why when I invest in stuff like this, I need a really big margin of safety. And I just don't think I'm getting it right now. But it's a fair value. Let me know what you think down below. Leave a comment, all that stuff. Like, subscribe. Thanks for watching. And if you want me to review any specific stocks, again, let me know down below. I'll take a look. Bye.